Welcome to another episode of Sean's Take on Asia, where we cover the latest news on digital asset development and policy updates. I have a new guest on today, Hong from Core, and he's going to share with us some of the experience that he's gone through, especially in the stablecoin space, and he's a veteran in this space, and you'll hear it from his sharing later on, all the way leaning into what he's doing now at Core as an institutional contributor. Hong, thank you so much for coming on the show.
Sean, thank you for having me. Great to be here.
All right, Hong. So we were just chatting earlier before we started recording. It looks like we share some common background and also common location. So before I moved back to Hong Kong, I used to live in New York, and specifically, I live on the Jersey side. It sounds like you're residing in that area as well. How is that whole area by the Hudson River evolving these days?
I mean, it's thriving. It's proximity to New York City makes it really convenient. Also, it's just great to be on the water in a really unique place in this part of the world.
Is the fireworks still being done on the Hudson River side, or is now moved back onto the east side?
I think it both. It probably just
It's kind of rotates a little
alternates
bit.
back and forth. Yeah, yeah. You
I
always see
remember,
fireworks everywhere.
right. I remember there were a few years where it was literally right by the Hudson River, right in front of the Empire State Building. So on my side was literally right in front of my balcony. It was quite amazing. Definitely something that I miss. So maybe what we could do is, if you don't mind, kind of sharing a little bit of your background. I've obviously kind of gone through what you have done. Really phenomenal, especially your work at Paxos. So maybe a quick intro about yourself, what you've done, and also what led you to where you are today.
Sure. So currently I'm leading institutional partnerships, as you mentioned, as an institutional contributor at CoreDAO, which is the leading Bitcoin scaling chain.
Mm-hmm.
Previous to Core, I spent 4 years at Paxos, leading partnerships across market infrastructure, regulated market infrastructure, as well as stablecoin partnerships. So what led me to Core is really a thesis around two key areas of the market. One being Bitcoin as a form of collateral, and then the other being stablecoins, where we can get into some of the what we talked about earlier, which is that stablecoin is at a precipice for growth, right? One of the opportunities for stablecoins and blockchain as a whole is really, how do we incentivize distribution via commercial incentives? How do we bring on the Web2 payments world, which processes trillions of transactions, and move it onto stablecoin rails, which is
Mm-hmm.
instantaneous, cheap, cost effective, and borderless. And one of the ways to do that is really to be at the sort of protocol level, where at the blockchain level, we can start to build some of the foundational sort of base layer that can actually facilitate both commercial growth as well as adoption growth to facilitate overall market growth for stablecoins, Bitcoin, and blockchain as a whole.
That's really interesting. I mean, we look at the stablecoin growth and the market cap the last few years. I mean, it's a straight line up, right? Especially now that President Trump has signed into law the Genius Act. I'm very sure that it's going to continue to push the stablecoin adoption, not only at the retail and more so on the Web3 native side, but really start to push forward on the institutional side from an adoption and use case perspective. I mean, when you were at Paxos, I mean, Paxos kind of really pioneered the whole notion of bringing stablecoin infrastructure and bringing stablecoin capabilities, working with some of the largest institutions in the world. Anything you can share during those 4 years at Paxos is, one, is a long time, but it also was that kind of that golden age of moving up in the market cap and working with a number of different players. I'm sure you've got a lot of interesting stories to tell. Maybe one or two that you think might be interesting for the audience.
Sure. I think there are two key areas where Paxos really led the way. Number one is just from a regulatory approach to
Mm,
stablecoin issuance. Paxos has always been steadfast around regulated stablecoin issuance. What that means is basically having a prudential regulator like the New York DFS or the MAS or even the ADGM to ensure that the underlying reserves that back stablecoins are transparent, are always grounded in treasuries, for example,
hmm
and they're always uh, they're always effectively can be attested to. And that contrasted with algorithmic stablecoins or others
Hmm.
that may not have 100% backing, ensure that Paxos was always able to sort of withstand any sort of market volatility. And we've seen a number of those. We've seen also now a lot of what Paxos has built actually written into law through the Genius Act. And so I think
Hmm.
they've been a pioneer in this space and really excited to see the first piece of crypto legislation around
Right.
stablecoins. And so I think we're going to see a lot more growth in that regard. And the market for competition and for different types of stablecoins issued by whether it's banks or institutions or via white label platforms like Paxos as the issuer are just going to grow. And
Right.
then number two, I think what personally I've seen is just the way in which you can grow stablecoins. At Paxos, we've seen sort of different cycles in stablecoin growth, right?
Hmm.
When stablecoins first came out back in 2019 with Circle and Tether and USDP and BUSD, that was really in an environment of zero interest rates. And that was product market fit where you needed a form of stable currency on chain that sort of offsets volatility of digital assets, Bitcoin, Ethereum, and others, so that folks can trade and remain on chain without having to move in and out of fiat.
Yep.
And that use case in of itself grew tremendously. Now what we're seeing is you have Circle and Tether as the market leaders, really earning a lion's share of that volume. And for any other stablecoin to really grow, it's going to take a sizable amount of effort and capital to essentially earn a share of that distribution. And that just means either through commercial incentives or utility to sort of catch up, if you will, right?
Right.
But also it exposes the fact that we're still at the beginning, very beginning innings of stablecoin adoption and growth. The market cap of stablecoins today is just a mere a single digit percentage of the M1 money supply.
Hmm.
And we've heard so many estimates of how we can grow into trillions and tens of trillions of dollars in stablecoin adoption. But the reality is, in order to get there, it's a trade off. There's an opportunity cost. And so that is really kind of what led me to Core, which is how do we actually think about how can stablecoin issuers compete with traditional rails to bring the benefits of stablecoins that is also commercially competitive
Mm.
to the existing rail that exists across credit card processing payments, bank rails, et cetera. And really kind of the premise of that, we think, and our thesis is that it comes down to being able to actually participate in the transaction level revenues or transaction fees that stablecoins generate. That's kind of in a nutshell
Yep.
where Core as an one can really support growth there, and that's precisely why I'm at Core today.
So a lot to unpack there, Hong. So maybe we kind of break it into two parts, right? You mentioned obviously that the market has evolved a lot. And during your time at Paxos, a lot of the core thesis is if you want this digital currency on chain to be used and trusted, then obviously you need to have some level of regulatory protection, assurance, I would probably say, in order for the users to feel like this is something that is backed not only by what the issuer claim, but also there's a form of audit, proof of reserve at the regulatory level. And I think we can already see that, right? Just actually a couple of days ago, I co-hosted an event here in Hong Kong just to really compare the Genius Act and the Hong Kong stablecoin bill in terms of some of the differences, but more importantly, the geopolitical implications for both of these regions to essentially start really looking at stablecoin as a vehicle, much less about settlements against cryptocurrencies, but really to drive the new economy. So I think that regulatory aspect is obviously quite important. What caught my attention in the second half of what you just shared is that revenue model. The stablecoin business has always been known as a net interest margin business, right? So essentially you earn what you're able to deploy. And since most fiat reference stablecoin, especially in the regulated side, are not about yield bearing stable coins, but more about like treating it just like legal money. Thereby, that yield is actually earned by the issuer. But that obviously has stopped. I wouldn't say stop, but it hasn't exactly kind of moved in the direction where we can continue to innovate on this form of money rather than trying to make it look as closer to what it was before. So this whole development that you guys are building at Core is quite phenomenal. I mean, maybe explain a little bit more about what you shared with me previously about the ref kind of model, right? What exactly does that do? I mean, there has been a number of stablecoin or protocols out there focusing very specifically on stablecoin, right? So they purposely build it for stablecoin. They have smart contracts that are built around it and so on. But none of them, as far as I know, have a incentive mechanism built in for usage. That is quite unique. Maybe you can talk a bit about that.
Yeah, that's exactly right. So Core announced a protocol level incentive called Rev Plus, which
Mm,
at a broad level allows any builder, which includes stablecoin issuers, RWA issuers, to capture a percentage of gas fees that they contribute onto the Core blockchain. And this is really kind of a collaborative effort across
mm,
builders, issuers, and specifically for stablecoin issuers. That means that issuers can now, for the first time, participate in earning a share of transaction volume and transaction activity on the Core blockchain. Today, as you clearly pointed out, the only revenues and 99% of all revenues that issuers make are from net interest margins, right? Essentially, for every dollar of stablecoin in issuance or in market cap and float, there is a dollar value of treasuries in reserves that earns
mm,
interest rates based on the current interest. And,
right.
and while that is extremely attractive in a high interest rate environment, we also see the limitations of that. And with certain issuers like Circle, which has already been publicized that much of the revenue is shared with distribution partners already, like Coinbase. It's limited in terms of what you can then share back with distributors. Primarily, if we're looking at trying to grow native Web3 stablecoin adoption, it means that the bigger pie is going to be, the bigger volume adoption is going to come from Web2, traditional payment volumes.
Hmm.
And the clear example of this is, take a look at Circle now in the public markets, and this is not investment advice whatsoever.
Of course.
But if you take a look at just the amount of stablecoin volume, transaction volumes that's been processed, I think in last year alone, it was somewhere north of $27 trillion, which exceeds the volume of both Visa and MasterCard processing,
Right.
right? Yet the public market cap of Visa and MasterCard are north of $1 trillion, whereas Circle is somewhere in the 40, 50 billion. It's not that there's a dislocation. It's not that this is an investment thesis by any means.
Hmm.
It means that the current way that Visa, MasterCard, and payment processing companies make money is based on a percentage of transaction volume
Right.
throughput versus stablecoin issuers today make money only on the reserves or the AUC of assets under management or assets under custody, right? That creates an interchange mismatch. So
Hmm.
if we were to incentivize a payment processor or someone who's processing traditional payments, right, in dollar or fiat forms to switch to a stablecoin alternative, they're going to have to essentially take a pay cut, right, into what they're already earning today. And so that is really one of the reasons why there is sort of a hold on stablecoin adoption at scale. How do we change this? The one alternative is for stablecoin issuers to actually pay for that volume, right, to
Hmm.
incentivize distributors, processors based on transaction activity. That, anyone that actually looks deeper into this would realize it's not really sustainable
Right.
because it's really hard to track, money movement in and out of stable coins. Someone can mint, your tether, and then the very next day move back into fiat, right? And the issuer would therefore not earn any revenues beyond that single day of assets under custody or that stablecoin remaining as a stablecoin. So what we believe at Core is really under this Rev Plus model, we invite stablecoin issuers, the Circles, the Tethers, and really any stablecoins out there to, or RWAs or even developers, when issuing on the Core blockchain, you actually participate in the transaction activity. So
Mm.
if you think just stablecoins, if there's $1 trillion of processing activity on chain, now there's actually a way to capture a portion of that revenue as revenue for the issuer, right? And that's really exciting. And that's actually a sea change in terms of how we think about commercials for stablecoins in the specific example that we're talking about. In another case for developers, if you look at a project like Polymarket, hugely
Hmm. Right.
successful, tons of activity and volume on the Polygon chain. But in addition, outside of earning fees on transactions, they're really not earning any fees on the transactions or gas on the chain itself.
Yeah.
Well, imagine if now a project like that on Core under Rev Plus, they can actually earn a sizable amount of revenue just based on the activity of the project on building on Core. That applies to game developers. That applies to standard DeFi protocols, exchanges. We think this is a huge change in terms of how we think about incentivizing, bringing on, not just current developers, but welcoming and ushering in the next wave of on-chain, blockchain development. And Core is uniquely positioned because not only is it a high-performance EVM L1 blockchain, you can build these smart contract dApps, of which we've already seen many examples of these on other protocols, including those already on Core, but it's also Bitcoin aligned. And so what I mean by that
I
is
see.
Core's consensus, right? Securing of Core, not only is it proof of stake through Core, right? You can stake Core assets, participate in consensus to earn Core rewards, but two-thirds of Core's consensus also involves Bitcoin in two ways. Bitcoin holders can time lock Bitcoin, which is a unique function of the Bitcoin blockchain itself, to vote
Mm,
on core validators, thereby quote unquote staking Bitcoin to earn rewards. And then also through miner hash rate. So mining pools today
I see.
are already delegating hash rate to Core. Two out of every
Mm,
three newly minted Bitcoin are helping to secure the Core network to earn block rewards, which then in turn acts as an additional security budget, which enhances Bitcoin's security and decentralization in the long run. So core sort of sits at the intersection, if you think about it this way, between the two sort of best fit or use cases of blockchain, Bitcoin and stablecoins, right? And so we really believe that core, launching Rev Plus lays the foundations for issuers, stablecoin issuers, RWA issuers, and builders to really capture and start to actually participate as a partner, right, in the growth of not only their business but also that of Core.
wow. Okay. So, this is probably the first time I've heard of the gas fee component really being passed back to the issuer. So really encouraging the issuers to really develop the ecosystem, expand the usage through various applications, either in Web2 or Web3 world, and essentially to then take not only depending on kind of the reserve asset model, but also to encourage transactional fees. And you're looking at it less from a kind of Visa, MasterCard. Every transaction there's a transaction fee, but you're actually bringing it down to the infrastructure level. So there's no kind of artificial contracts that you need to do to say, every $100 I'm sending, I'm charging 2% or 1.5% or whatever it is. It's actually now embedded inside, so the users don't see it. It's automatically sent back to the sent back issuer. That's very interesting. Now that begs the question, though, if you don't mind me asking. I mean, typical protocols. I mean, the gas fee goes back to the protocol, right? That's what kind of runs the operational aspect of the protocol. But now in this case, you're actually sharing that with the issuer or the applications that are using the chain. So how does that work from a commercial model perspective now at the layer one level?
Yeah. Look, we look at it as rising tide lifts all boats, right?
Right.
The foundation obviously has to sustain itself, and there's more than enough for the foundation to be sustainable. But we're making a long-term bet on blockchain itself.
Mm,
If we're able to incentivize the best builders to build on core through this shared incentive model or through best in class participation of blockchain innovation, then really we all win in the long run. If we
right.
are able to help stablecoin issuers build sustainable revenue streams in a low interest rate environment, for example, that helps drive stablecoin growth that is market agnostic. That also drives Bitcoin growth. And that's
Mm,
how we really now also leverage the largest and Genesis blockchain asset to help fuel the next wave of blockchain
Yes.
growth. We're already seeing a lot of that happen through the other side of core, the one side being the ecosystem growth where Rev Plus is a key initiative. The other side is, as I mentioned, Bitcoin yield, right? We look
Right.
at that as an infrastructure level building block, making Bitcoin composable, productive as an asset because it can now earn yield. And on top of which, companies both on chain and off chain are building really cool distribution products that generate yield for clients. On chain, we have Maple Finance building LST which is a
Mm-hmm.
yield bearing Bitcoin asset that can be used as collateral, posted custody off exchange with qualified custodians like BitGo,
Mm. Yep.
where the underlying Bitcoin is secure, but as a liquid asset that can be used and posted as collateral to then earn, 2-3% carry while funds are executing strategies on Bitcoin across derivative exchanges. To ETF, ETP, SMA issuers creating new traditional financial market products. We already have DeFi technologies that issue the first Bitcoin yielding ETP that's building on Core's
That's right.
dual staking mechanism. And we see growing demand, accelerated demand, and we'll likely see the next wave of ETF, ETPs that have Bitcoin yielding components in the latter half part of the year. And what that means is, just not to get too sidetracked here, but it just means that if we look at Bitcoin ETFs as the fastest growing product or ETF product in the last, call it 5 years, a
Right.
Bitcoin yielding ETF, right, it's going to be even a bigger attraction. For many of the
Mm.
asset managers that have sat on the sidelines on Bitcoin, if you give them now a way to earn, positive cash flow while having Bitcoin exposure, that's just a no-brainer for any portfolio
For
and
sure.
any asset manager to actually, add the best performing asset over the last 15 years to their portfolio. So,
For sure.
all in all, it's through those two areas that Core is so uniquely positioned to not only facilitate but really benefit and join and sort of help usher in this next wave of growth on chain.
That's amazing. That's amazing. When the Bitcoin and ETFs were coming into market, Hong Kong coincidentally was actually the second jurisdiction in the world to have these products in place and regulated by our local regulator. And the regulator here actually created this model of allowing for in-kind subscription and redemption. So what that meant
Yep.
was a lot of the Bitcoin whales or miners would naturally see this as a way to potentially park that Bitcoin that they already have in storage, but essentially park it in a recognizable kind of financial products, right? That could be easily recognized on their balance sheet. So
That's
now
right.
adding a yield staking component essentially make that very, very interesting. And actually, I think around both in the US and also here in Hong Kong, we're now starting to see kind of staking being mentioned in the policies and also being allowed in tokenized products, including Bitcoin ETF. So very interesting. I think what you guys are building at that core foundational layer, along with where kind of regulatory development is moving towards and where institutional adoption is moving towards is kind of right in line, right? Right in line in both the Bitcoin side and also on the stablecoin side. So very, very interesting. Thank you so much for kind of sharing your phenomenal background. Obviously, I say I'm in the stablecoin space, but you've been in the stablecoin space, really deep in the trenches, much longer than most. So really amazing insight that you shared. I'm actually going to ask my team to reach out to your team, really understand a little bit more about that infrastructure and see if this is something that both we can use as a stablecoin business, and more importantly, whether this is something that is worth kind of bringing up to interest party, especially from the regulator side, to help them understand that the world of stablecoin on chain being transacted actually can evolve in many different ways that are still very compliant. So that's obviously their number one concern and always worry. But at the same time, still have that kind of innovation component to it. So I look forward to other conversations that you and I can have and our teams can have. But with that, thank you so much for coming on the show. This is really amazing to kind of hear an industry veteran in the stablecoin space and really looking at how things are evolving. Loved it. And I'm sure the audience will find your insights incredibly, incredibly, interesting and attractive. So thank you very much.
Thank you, Sean. Happy to be a resource. Excited to start on this journey together. Thanks again for having me on the show.
All right, so that's it for another episode of Sean's Take on Asia. If you like this content, please give a like and also subscribe to the YouTube channel. Until next time, keep innovating and keep demonstrating the transformational promise of Web3.